Today we are going to be talking about the topic of carried interest. Now, carried interest has gained a lot of traction in the business community and also in the political landscape. We've seen even back in the 2016 election when President Trump got elected, both sides, Republicans and Democrats, were discussing carried interest. And on top of it, even today with the new administration, nothing has necessarily been done about carried interest at this point. The laws have currently stayed to where they have been in the past, and this is an issue that has been very difficult to get across and to get something done on because there's a lot of lobbyists and there's a lot of organizations that are looking to protect carried interest, and it's very difficult for politicians to do anything specifically about that. So let's talk a little bit about what carried interest is. Carried interest, as I've discussed earlier in a lot of these other projects as well, is the compensation that private fund managers get when they do acquisitions and they buy companies or buy properties, meaning that once they sell these assets, they get a portion of profits, and carried interest means it gets taxed at capital gains versus ordinary income. Now, the Biden administration wants to abolish the carried interest loophole, and they call it a loophole because what they think is, and this is more of the Democratic perspective versus Republicans, but they believe that fund managers, kind of rich fat cats, should not be able, right, to make a lot of money and only get taxed at capital gains versus the average worker or blue-collar worker that could be working very similar amount of hours, busting their tail, and they're getting taxed at ordinary income, which is much higher than capital gains. There's been studies that in 2018, right, the Congressional Budget Office estimated that taxing carried interest as ordinary income would raise $14 billion over nearly a decade, which is a sizable amount of money. And the administration believes that this additional tax revenue will allow for their ambitious social spending programs. And with these social spending programs, it takes money. So that's why this administration believes that ending this loophole will allow them to have the funds necessary to have their goals accomplished and to have these spending programs be taken care of to help low middle class people and others who are not as well off, we can say, as wealthier Americans, and that's who the administration is trying to target and tax from. The issue has attracted, as I mentioned, both sides of the aisle in the political landscape. Now, Republicans and Democrats, as discussed briefly earlier, Democrats are typically the party that wants to support low-income, middle-class folks, and they want the rich to pay their fair share, versus Republicans, who are a little more generous towards the rich, but they have a persona that let the free market be the free market and let businesses operate in a way that doesn't hinder economic growth. So where this all ties in this big media news story that's been around since 2016, 2020, and even before that, when Obama, all these other presidents were there, this issue's always been up. There is a lobbyist group that is called the American Investment Council. Now, the American Investment Council is an advocacy and resource organization, and they provide insight on the private equity industry. Now, as stated before, the private equity industry are the fund managers who take advantage of this carried interest loophole. This group supports private equity as a sound source for long-term growth in the U.S. economy. They would say that, well, which is actually true based on their numbers, is the private equity-backed companies employ more than 11.7 million workers in this country, and according to them, out of these investments, 86% went to small businesses in 2020. So their argument would be private equity is essential because we employ over 11 million workers in this country, and all of the investments, or the majority, 86%, went to small businesses. So you could make the argument from this that, well, private equity isn't supporting only the Fortune 500 companies, the rich fat cats. A lot of the money that is raised from private equity funds is actually going to Main Street America. It's going to those small businesses, you know, the family-run donut shop or the family-run restaurant. So all of that capital, what these people are arguing is that it's helping the middle class and it's boosting the middle class because the money's going to Main Street versus Wall Street. Okay? And also, private equity investment in renewable energy surged to $23.7 billion in 2020, up from roughly $5 billion in 2019. Now, as we've seen as well from both sides of the aisle, there is interest in renewable energy because renewable energy is the future. The Democrats want to get there a little bit faster, but the Republicans want to get there eventually. But what their belief is that energy costs and renewable energy is too high, and we have to allow for the free market to lower prices so that it's more economically sound. But the private equity industry, they're saying here, hey, listen, we're progressive. We're looking towards the future. We want to invest in renewable energy. And in just 1 year, they have 4x the amount of capital that has been allocated towards renewable energy. According to the American Investment Council, the private equity industry benefits investors, companies, workers, and communities. Because their argument would be it's not just the investors that we're raising capital from. The companies benefit because we're increasing performance and their productivity is getting higher. The workers benefit as well because when the company does better, ideally wages should go up. And communities, because a lot of these companies serve their local communities, and with a more better run, if you want to say, company, the community should have a positive impact as well through that business succeeding. They also state that investors get larger returns and less volatility than public markets such as traditional equities, which would be stocks, right? So looking in the market solely from an investment perspective, if you're an investor and you're going into the stock market, you can make decent returns, but there's a lot of volatility. And what I mean by volatility is your returns are not necessarily stable. But in private equity markets, since your money is tied up for a long period of time and you have a longer hold period, the returns historically have been higher. And also, you don't get that volatility that you would in the stock market. So an argument from an investor standpoint is we're impacting communities, we're making these companies better, and hey, our returns are even stronger than they were before when we were investing solely in stocks. And then companies receiving private equity investment benefit from access to capital, expertise, and business mentorship. Because in private equity, what happens is when they take over a company or acquire a company, they put in their own management. So the existing employees who work at that company can benefit from the new management, and they could get business mentorship as well, because these PE firms have an incentive for these companies to perform from a return standpoint. So they're going to bring the most best and brightest people who are operators to come in, and all of the people within the company who are existing and who have been there forever can, one, stay on, and two, benefit from learning the mentorship from these new operators that are coming in. And lastly, as mentioned before, going back to the main topic of carried interest, which is a huge debate, according to the American Investment Council's website, here is their definition of carried interest and why they believe it should stay. Carried interest capital gains is the portion of investment profits fund managers contractually receive based on the agreement with the fund investors. It is not a fee or loophole. This compensation is profit gained from putting money at risk and investing for the long term. The key criterion for capital gains treatment is whether the taxpayer has made an entrepreneurial investment of capital or labor or both. Private equity fund managers meet this test. Carried interest capital gains is important because it serves to align the fund manager's interests with those of the fund's limited partners. If the fund does well, the general partner shares in the gains. If the fund does poorly, the general partner receives no carried interest. So this is their argument. And what they are saying is the compensation that they get from selling these companies once they do a successful exit, it's an entrepreneurial investment and there is risk involved. So since they are allocating a lot of capital and there is risk involved, they believe that they should be compensated by having those profits be taxed at capital gains versus ordinary income, right? And on top of it, if the fund does well, the general partner shares in the gains, meaning they have to meet their return threshold. And if they meet their return threshold, they're able to get the carried interest. However, if the fund does not perform well, and if they do not meet their return expectations that they gave to their investors, then they receive no carried interest at all. So they're saying we have a 50-50 chance that our investments might not perform well and we wasted all this time and get no carried interest and we wasted 5 to 7 years. But then the flip side is if we do a good job, our interests are aligned with our investors and we do good for the community and we meet our return objectives, we should have favorable tax treatment of getting taxed at capital gains at 20% versus 37%, which is the top marginal tax rate today for traditional income tax. So that is their opinion. That is a large heated debate right now in regards to carried interest. It's a difficult topic, but this community, AIC, they are advocating for keeping the carried interest loophole and making the economy flourish as they think private equity allows for, and they want nothing to change.